morning, I'm Brian Tugend. This is Markets in a Minute for the week of December 22nd. In the last full trading week of 2025, markets were a bit choppy, which sent the S&P 500, at least temporarily, below its 50-day moving average. Markets continue to struggle with what has been at the forefront of investors' minds over the last few weeks, that being concerns over lofty expectations and frothy valuations around the AI trade. All that said, though, with just a few trading days left, equity markets still look poised to close out a very strong year, with the S&P 500 currently higher by around 16%, while non-US value stocks are up roughly 40% and emerging markets are up 30%. Switching gears to the economy, it was a very busy week with all the reporting delays caused by the shutdown. Starting first with the jobs data, we got non-farm payrolls for both October and November, with October showing a loss of 105,000 jobs. However, the data was highly skewed by deferred resignations from federal government employees, which detracted 162,000 jobs. So we can take that number with a grain of salt. November, though, still highlighted sluggishness in the labor market. 64,000 new jobs were created, which was above expectations, but this is still meaningfully below what we've seen for much of the last few years. We also saw the headline unemployment rate tick up to 4.6%, its highest level in 4 years. Now, on the inflation front, we got CPI on Thursday, which saw an unexpected cooling in the year-over-year number. According to the report, prices rose by just 2.6% since last November, which is the slowest annual pace since early 2021. Normally, we'd expect this to be a dovish sign for investors. However, the government shutdown did cause some data collection issues at the BLS, which had many economists calling into question the legitimacy of the report. As a result, this did little to change market expectations for interest rates, with investors pricing in the next Fed rate cut for March of 2026 at the earliest, with April looking like the more likely outcome. Now, looking ahead to this week, it will be a shortened week because of the Christmas holiday, and the days where the markets are open will likely see relatively low volumes. On the data front, we do get our first look at Q3 GDP, which is expected to come in at 3.2%, so definitely something we'll want to keep an eye on. With that said, I would like to wish everyone a happy and peaceful holiday season. Thank you for watching this episode of Markets in a Minute. Don't forget to like, share, and subscribe to get notifications for future video content. Have a great week.